I'm delighted to introduce Richard Ketchum for his Q&A keynote with Gina, Chon. Richard is the chairman and CEO of FINRA. Previously, he was the CEO of NYSE Regulation. He served as the president of NASD and NASDAQ. And in 2014, he was appointed by President Obama to serve on the President Advisory Council on financial capability. And he's been very helpful at our previous conferences. And we are delighted to have him back again at Georgetown. Ladies and gentlemen, Richard Ketchum.
Hi, Gina. How are you?
Hi, I'm good. How are you doing?
Good.
And thanks to all of you for joining us today. I'm used to chasing Rick down at various events that FINRA has, so it's good to have him stationary here. So,
without Nancy in between.
Yeah, exactly. No. So I guess, first of all, there's obviously been a lot of talk about market structure and what's exactly going on in the marketplace today, and whether investors are disadvantaged given the technological advances, and whether sort of the mom and pop investor can keep up with all of this. So I just want to step back for a bit and just get your thoughts about, where we've come from. Are the markets better than they were 5 to 10 years ago? Are investors better off overall? What are your thoughts on sort of the state of play?
I think in very many ways has been. I don't know if we can turn. In very many ways, I think that the answer to that's quite clearly yes. Obviously, it's in fact, if it's anywhere most clearly yes, it is with respect to mom and pop investors that should not be trading continuously and are looking for simply a narrow spread environment to execute their trades. I'm not going to add in any meaningful way to the range of discussions that came today, either on the regulatory side from Dan and Steve, or on the type of quality papers that Jim Angel has done with his cohorts like Larry and Chester and a range of other things, which I think demonstrate pretty clearly and demonstrably that from any effective or real spread analysis, any real analysis from the standpoint of somebody trading occasionally in the market or regularly in the market, that the markets are substantially better and provide more quality executions than ever before. So I think that's easy. You look at other things that have been improvements over the 5 years without suggesting they're perfect. I think when you look at the world from a flash crash environment and where it sat there, which was clearly an environment where the tonicity of the market wasn't what it could be, or if you want to be simple, you could make an argument that the market was unsafe at any speed. And that, in an environment in which you've done great things from the standpoint of reducing barriers to access to create a wide range of different market-making capabilities, dramatically enhancing competition, significantly increasing transparency from the standpoint of lowering, without getting into the range of fascinating discussions in the last panel, lowering tick size and the rest. That's all great, but you create an environment where, if you don't do anything else, where you have that level of democratization with respect to market making, when you move to a situation that is at least not instantly explainable, the likelihood is a withdrawal of liquidity on a fairly absolute basis without the withdrawal of sell activity at the same time. And that's what you saw in the flash crash. That's what you've seen in a range of different sizes in a mini environment since then. As Pete notes, you've seen it in asset classes for a variety of reasons all over. We're certainly not in the same position now. The step-by-step effort with respect to single stock circuit breakers, moving the limit up, limit down, is maybe not the most elegant solution that could ever be provided, but it creates an environment where, one, there's an ability to instantly react to the extent that from an electronic standpoint, the marketplace will recorrect, or if it doesn't recorrect from an electronic standpoint, allows a stand down time that's reasonably short to allow liquidity to come back in the market. So I think from both of those standpoints, both from the overall efficiency from any reasonable measure you want to look at with respect to retail investors, as well as from the standpoint of the lesser risk from a volatility standpoint. We sit in a generally strong position today, which is not to anticipate further questions you may ask, not to suggest that there aren't other things to look and worry about.
Yeah, well, and that goes actually to my next question. Are there any groups of investors that you feel like are worse off, or there is a need to restore confidence among certain investor groups? That's been sort of a worry among lawmakers and some regulators with allegations that the markets are rigged and the publicity that has been surrounding that. Do you see any investors that are actually not doing as well as they were in the past?
Well, let me back into that question.
Okay.
Certainly, one of the upside with respect to dramatically lower barriers to access is increased competition, reduced spreads, and a range of things. The downside, particularly when it's combined with fairly rote rules from an execution standpoint, like Reg NMS, is an environment of complexity. Complexity is not necessarily good nor bad, but it raises a range of issues that are worth thinking about. Obviously, different institutional investors have strong views from the standpoint of what strategies have been taken away from them in the environment of complexity with respect to the increased ability of people to quickly discern and react to movements and selling or buying activity. Maybe right, maybe wrong. They feel strongly, and at least I wouldn't say that the economic analysis is fully clear from the standpoint of that, from an institutional trading standpoint. I'm a regulator, so I look at complexity from other questions. Complexity tends to create more conflicts of interest, whether that be make-or-take pricing, whether it be payment for order flow, whether it be a range of potential one-off deals with respect to the vast numbers of liquidity providers in the marketplace. Each of those can create issues from the standpoint of decisions, from an order routing, best execution standpoint, and the like, that are not simple. Similarly, complexity from the standpoint of wide open access creates different opportunities from a manipulation standpoint. High frequency trading on the whole has nothing to do with manipulation. The vast majority is really pretty simply explained from a range of strategies that we've all seen in different ways on floors of exchanges and trading upstairs over the years. But unquestionably, it has also created the opportunity for things at the edges which are manipulative, whether it be range of momentum ignition strategies, simple bald things like marking the close and wash sales, and the fact that accountability rolling through multiple layers, often from trading across borders, is very difficult to enforce. So that each of those pieces create concerns, and then obviously there are the pieces that are not illegal, but perhaps troubling from the standpoint of the delays in reporting from the standpoint of the standard SIP that public investors are seeing, and the reality that with respect to different times and reactions, there's an ability for legal tape racing occurring across marketplaces. None of those things are perfect. From a balance standpoint, would I probably take them? Yes, but would I be interested in trying to get to address a variety of them? Well, sort of. That's why, as many of you have probably seen, obviously in partnership with the SEC and basically responding to Chair White's speech, we've got a range of rule proposals that the board will consider next week that I'd say drop into sort of three categories, and be glad to talk about them later if you want. One piece relates to creating greater clarity and transparency with respect to the market from investors, increasing the amount of reporting with respect to non-ATS trading upstairs, clarity from the standpoint of late trades that now create confusion from that standpoint, greater specificity and granularity from the type of audit trail information that regulators need to identify manipulative activity, and there are different pieces of that we're glad to talk about later. And then finally, greater accountability from a supervision standpoint and from the persons that are directing the development and the design of algorithms, not the guys doing the code, but the folks that are truly directing it from the standpoint of expecting them to meet registration requirements and testing requirements that are not different from other participants in the market. So I think those are different. There are a lot of things to look about and think about in a world of greater complexity. Doesn't make me want to turn back the clock, but it does mean that it is worth seriously paying attention to what the downsides of complexity are.
Sure. Well, since you mentioned the FINRA meeting, there's a meeting this Friday where, as Rick said, they're going to be considering a range of proposals that I will be covering and a lot of other journalists will be covering.
They're so interesting.
I know, exactly. You're a popular guy. So Chair White had given a speech, as you had mentioned earlier this year, that talked about sweeping changes in market structure, regulations, more transparency, working with FINRA and other SROs on various aspects where they can work together, but also looking at Reg NMS and some of the changes that had already occurred and whether there have been some unintended consequences. With the FINRA meeting coming up on Friday, where you did give a little bit of a preview and just other things FINRA is looking at, where do you come down between sort of increased transparency, increased disclosure, where that's obviously a lot of this discussion, versus actual changes in market structure, whether it's, you mentioned the maker-taker model, there's
Sure.
been a discussion of whether that should be eliminated or at least reformed. How far do you think some of those suggestions should go?
Well, I come down being very glad I'm at FINRA and not at the SEC, because
Yeah.
I think my answers are from the standpoint of what's appropriately in FINRA's side are I think simpler. I do believe that there's no reason why there shouldn't be greater understanding of the amount of activity that whatever you think from whether we've reached an inflection point with respect to activity occurring away from an exchange. There's no reason not to look for a range of efforts to increase that transparency. No reason why the voluntary efforts done by a variety of ATSs shouldn't be continued to press on from the standpoint of clarity, with regard to order execution and operation with respect to ATSs. Same thing with respect to the large firms' executions and clarity from that standpoint. No reason why we can't take simple, relatively low-cost steps to improve the quality of the audit trail. We have clock synchronization times now that simply are irrational with respect to how the markets have evolved at a second. Ought to be down as what was agreed with respect to what we in the CAT side and the bidding side are required to do from the standpoint of 50 millisecond sync. At a minimum, we ought to be looking at those type of levels with recognizing there may be cost implications. That's not perfection, that really does, but that allows an ability to more easily sort and detect potentially manipulative activity than we've got today. Consolidated audit trail, I know we'll talk about a little bit later, but basic steps are the fact that there's a range of broker-dealers that are not FINRA broker-dealers that are not clearly identified in an audit trail basis today. That's nuts. We've moved from a world in which there realistically were 10 to 100 entities that could realistically effectively manipulate or impact the marketplace to a world where that's counted in the thousands, and in which the registration of that person or whether that person is a FINRA member is relatively speaking an accident. So looking for things there makes sense. And as I say, a key piece of complexity is addressing the error risk, and that requires continuing to tighten the screws and tighten the clarity with respect to accountability, with respect to oversight of algorithms, and clarity with respect to the people designing them, that they really understand what the regulatory requirements are. I mean, we different about disclosing cases. We see fascinating emails in which folks basically introduce themselves to broker dealers, explaining to them the variety of momentum ignition strategies that they'd like to complete, and their desire for various different pricing issues and design to allow them to do it as effectively as possible. These people may need some more training.
It's an understatement, possibly.
Possibly an understatement.
Yeah. Well, going to that topic, how do you see FINRA policing this space when it comes to not just oversight and increased transparency, but actual enforcement, whether that ends up being in fines or private letters to various market participants. We've already seen actions take place elsewhere in various government agencies. How do you see FINRA's role, and is there also a concern of going too far, just given all the publicity around market structure issues that some are worried about, loss of liquidity and other things because, there's just so much more attention to it?
Yes, there's always a risk of going too far. I think it's a great opportunity to have conferences like this to talk about the things we're concerned about, because I'd vastly prefer the industry to respond and react to it rather than the other way around. Some things are complex to prove, but pretty simple from a buy-in standpoint. It's not a super idea. It is. There are a range of explanations from the standpoint of cancellation and entry of orders that may or may not suggest manipulation. But if you do them 100,000 times a week, then you're in a pretty good situation from the standpoint of proving it. There are a range of things that are at the edge of what I think are legal requirements and best practice requirements that deserve more discussion and generally probably aren't appropriate from an enforcement standpoint. We'll spend some time trying to provide greater clarity of supervisory obligations. I personally believe that there continues to not be the across-the-board attention from the standpoint of a range of detailed kill switch approaches as opposed to online monitoring with respect to trading in the broker-dealer side. Is that the right thing from an enforcement standpoint? I'd certainly prefer not. But are we creating concerns from the standpoint of market impact and investor confidence from the absence of attention to it? Yeah, and so I think some way or another there has to be a raising of the bar from the standpoint of that. A large part of what a regulatory system ought to be, and this is something we've come late to the game on, is it ought to be as transparent as the marketplace is. We try now as much as possible to send out report cards to firms basically identifying how they look vis-a-vis peers with respect to a range of trading and reporting information, and essentially tell them the type of things we're concerned about that we expect a response to. If they fix that, I'm happy, and that's a far better way to do it from an enforcement standpoint. But the basic issues from the integrity of the market with respect to not blowing it apart with regard to paying a lack of control, focus on algorithms, and not manipulating it with respect to a range of crude tactics, those are things that should be about enforcement.
Yeah. Well, given some of the recent moves that FINRA has made to collect information from market participants, you have the ATS information coming in now. That in and of itself has actually raised the sort of light shining on that, is even just for us as journalists covering that space. You mentioned the CAT system. You have cards coming up in terms of gathering that information for that proposal.
We've never seen an acronym we don't love.
Yeah, no, exactly. Well, that's the whole regulatory system, I think. But what have you learned so far from the collection of some of that information, and has any of that surprised you? Like, take for example the information that FINRA has now on dark pools and volume.
Well, we've been seeing that information for some time, and to Rosenblatt credit, much of the information was out there in the market. There just wasn't assurance of consistency and full compliance, which I think is important. I think it has been interesting to see the evolution in volatility and response from the order routing side to various different issues from an investigatory standpoint. Our friends in New York. And I think generally it is interesting for any set of decision makers to understand more completely where order flow is going and whether there are trends from that standpoint. I think equally having that information with respect to the rest of the unlisted part really important. Same thing, the pieces that we'd like to do for greater specificity in how we look at a range of manipulative things. we now get order book information from exchanges. We don't get order book information with respect to ATSs. But obviously, calling that dark information is a misstatement from the standpoint of the actual participants with respect to those systems. In some cases, yes, some cases not. Gaining that information is important to really understand what's going on in the market. So that, none of these things are profound. They're certainly, I think, understanding better and far greater clarity from the standpoint of any one-off relationships and execution parameters and order descriptions. Those, frankly, probably more important than that. But each step is a step to give a greater comfort and confidence to investors that they're really seeing what's going on in the market, and hopefully provides valuable information from researchers to take a different look at stuff.
Mm-hmm. And when it comes to execution, there's been a lot of talk about order routing and sort of who gets to jump ahead of the line in certain respects. Where do you see sort of broker routing going, the order of that, and just the concept of best execution? I mean, there's been some talk. I was at a conference sort of like this with lawmakers, and Bob Greifeld of NASDAQ was there, and he talked about how that phrase almost seems meaningless these days because of how the market has evolved, and there's no sense of what that exactly means anymore in terms of best execution. What are your thoughts on that, and what regulators can do to help make sure that that is a reality of the marketplace?
Well, it's a great question. Let me divide it into pieces. First, I'll refer back to Dan Gallagher. I won't get into it, but it is remarkable that we spend so much time worrying about basis points and equity as well. Fixed income is in nickels, dimes, quarters, and dollars. But I think best execution is a range, or execution quality is a range of questions, some of which are properly legal, some of which are properly transparency questions, some of which are problems. Let me talk about my concerns first, where I see it. We regulators tend to worry about where there are conflicts. You mentioned maker-taker pricing, mentioned payment for order flow a little before. I leave to the SEC the range of issues from the standpoint of market structure, but the reality is that drives a range of conflict decisions that deserve special attention. And I give great credit to Rob Pedalio and a range of papers that are beginning to come now to begin to focus on those conflict situations. I think priced order routing deserves much more attention, and it is a large part of what we're focusing on now. Some may have read that we're in the midst of a sweep as the SEC, looking at a range of things. A particular focus is from the standpoint of priced order routing, because there's a wide range of questions as to the difference when you're talking about meaningful maker-taker pricing in narrow spread environments that can reach decisions which, at least intuitively and at least with respect to the amount of statistical analysis that's been done so far, suggests subpar results and somewhat intentional subpar results for investors. I think that were I in the industry, I would be all over that from an execution quality standpoint, and I would be looking to fix it now. It is certainly going to be a huge priority for us in the next 6 months, looking around it. Next step is I throw to this room. I think there's a range of interesting questions about what's useful and not useful from the standpoint of the 605, 606 information, how we've evolved from a market maker environment, and yet that information still is tagged in a variety of ways that may not be the best way to look at it. I'm not sure I'm smart enough to come up with the things. I think it would be great for this room to really begin to think seriously about the right type of, or at least supplemental ways to look and think at execution quality. Pete was raising some interesting things that might be part of that question out there. Third piece, just to state the obvious, is some things are legal, whether you'd like the markets to design that or not. And allowing somebody to quickly react to a transaction price and getting that information quickly because of their willingness to pay a premium for doing it is legal. It isn't front running, and it is not something that is a matter of regulatory concern from an enforcement standpoint. Are there questions as to how markets should be designed from that standpoint? Of course. And those are very valid things to look at. But that part, I'll agree with Bob, That's not a best execution issue. So to me, there are some very real best execution issues. There are some very real questions from creating more quality and useful transparency. And there are other things that are really market structure choices and not beyond that.
Yeah. Well, what about this talk about, leveling the playing field, and certain people have advantages and others are disadvantaged. But there's talk of, for some of the market participants who are providing that liquidity, there needs to be some incentives for them. If you take it all away, then they're not going to want to provide that liquidity that the market needs for it to function properly. Do you think that there is a balance there that can be reached, that certain systems, or whether it's maker taker or other models, don't necessarily have to be eliminated entirely, maybe reformed, but there needs to be some incentives for liquidity providers?
I'm an old market guy, so I do like liquidity, and I am caught somewhat in my path. I mean, I think those are great questions that ought to be fundamentally decided from data. I look at, I won't say that I would necessarily design the markets as they exist now, but I look at any reasonable or liquidity measures that I normally look at, and I don't find that concern, other than the tonicity concern I raised before with respect to risk of withdrawal from the marketplace. I do think there are interesting questions, and I applaud the SEC for taking a look at a range of studies. Although what information get out of them, time will tell. I mean, I was involved in an advisory committee, just to note this. FINRA regulates. We don't think about these things, but the advisory committee, and we raised questions as to whether there had we'd moved close to an inflection point from the amount of trading that occurred away from a exchange environment, and particularly away from a limit order book environment, and operated from the standpoint of upstairs trading. I think those are reasonable questions. I think there are reasonable questions as to there should be, whether it be called some form of trade ad or otherwise, whether there should be a liquidity provision expectation for being able to manage substantial order flow and execute it away from an exchange. I don't think they're easy answers, and I think there are great arguments on both sides. But I think those are things worth looking and thinking about. And I think it is. Well, I know the SEC's pilots are all about looking at the impact of ticks at 5 cents or 10 cents. It'll be interesting to see some of the results of the differences that they provide between the three pilots.
Yeah. And what about just the speed at which the market operates now? One of the things that Chair White had mentioned when she gave her speech was also, trying to figure out ways to not have speed be sort of the ultimate goal for certain market participants that can jump the line and be ahead of the queue, and creating algorithms that would allow them to do that. But do you think, from a regulatory standpoint, there is a way to really provide disincentives for that, or the market is what it is, and that's how it operates, and that's what people are going to jump to?
It's a great question, and I would not. I don't think it should be easily shrugged off, because we need to respect the concerns, the genuine concerns that investors have with respect to a market. I think both because of their perceptions of speed and the reality of complexity, they feel uncomfortable with. My instinct is that most of the solutions are likely to be more costly from an impact to market quality than their alternatives, and obviously they've been fooled around with on possibilities with respect to Europe. I say I'm a little bit more open to experiments in places like Canada and Australia with respect to one version or another of trade at type requirements, and I think there's more work to be done in that, making a decision on or evaluating. And my gut feel is that Western civilization probably will survive either way. And near as I can tell, Canada and Australia haven't fallen in the sea, and neither have we. But I think that I think there are things at the edges that are not so much at the edges. I think the exchanges in FINRA with the SEC have recognized that that the SIP latency that exists today, whether or not you believe you want to explore the type of thing Dan Gallagher raised this morning, is unacceptable. And that plus the assurance and backup capability of it absolutely has to be addressed. Can you get immediacy without delaying? Obviously not, because it's another set of calculations. You sure as hell can get a lot closer. And you can do a range of other things to make the market, some of which we propose, not quite so confusing and appearing inexplicable. And outside of that, I kind of like IEX type competition better. I mean, if people are willing to pay for, people are willing to pay for assurances that there's not an ability to run from one market to another market with respect to an order, that I think that's great to compete that way, and I think it's interesting to do. And I think if there becomes choice over time where that becomes a substantial adoption, then maybe that should be a norm. But I think it's just as we've seen competition again and again with the introduction of ECNs, ATSs, and a range of other steps to try to increase efficiency in the market, it seems to me if the concerns from the standpoint of running from market to market are sufficiently great, then competition should gradually move the marketplace to a different norm. And I'd like to see that happen first. But as I say, I think I have many great friends that I have tremendous respect of their trading knowledge and the rest that feel strongly about those issues. And I think it will be interesting to see how entities like IEX evolves and whether there are other adopters to what they're doing.
Yeah, no, it'll be interesting as they apply to become a full exchange, what happens with that. So, well, it's a good place to wrap up. We have some time for some questions. If anyone wants to ask Rick what is on tap next for FINRA.
Hi, Joe.
Rick,
how you doing?
Hey, Rick. Just curious about the order book information on the ATS front, and is that just sort of like an interim measure before the CAT, so you have that information, or are you guys going to do anything with that in terms of, so just is it for surveillance purposes, or might there be more disclosure? Because a couple of the ATSs we deal with have asked us about that and are kind of concerned.
The answer is there is no present plan to look at that from a disclosure standpoint. I think one of the, just as we're trying to look and understand the changes in the marketplace on the fixed income side that Dan Gallagher talked about, I think we'll be interested in looking at that information value and a range of other stuff. We are not interested in people being able to reverse engineer and trade off of information. Obviously, tried to deal with that even with respect to the more basic ATS information and the like from time delays. So I think there's a lot of trading advantage issues that we'd have to work through before disclosing it. Most of the things basically are sort of simple. You're moving to a world with CAT, which is remarkably more granular from the standpoint of how you look and identify trade sequences that in one way or another are abusive or manipulative. But there's a range of steps to allow you to identify a range of gaming activity before that. First, understand the players that are actively trading, at least if they're broker-dealers. Secondly, understand the games that may be played in ATS book information, something that the ATSs are pretty good at looking at, just as much as you look at it from the exchange side. And third, get the clock syncs to a point where you at least have a fighting chance from a sequencing standpoint to have better information. And I think that's our goal now. Whether that type of thing from a transparency standpoint with substantial delays makes sense, we're open to talking about it, and you may even see us ask a question about it. But that's not a near-term thing or something that I'm sure is a win.
Another question?
Guys have been doing it for a long time.
Yeah, I think everyone here.
It's tough to bounce back and forth between regression analysis and a bunch of regulators.
Oh, wow. Oh.
I think she's a very smart woman who cares passionately about what she's doing. I don't think about individuals. I think about positions. I think Elizabeth Warren has advanced things that needed to be addressed, whether they've been addressed perfectly or not. The CFPB may not be the perfect solution, but the recognizing that there needed to be some address from the standpoint of the range of consumer issues with regard to banking-like products, I give her tremendous credit for raising and demanding attention. I think that we may not have the best solution, but that issue is real. I do think it is appropriate to worry about people in the industry being held accountable for their activities. I'm kind of a view that you actually have to prove culpability on an individual basis before you hold accountability, but I'm certainly a believer in accountability. And, the world tends to be better with contrarians looking in a variety of different directions. So I think it's great that she brings a contrarian focus.
Good answer.
Best I could do in a wing.
Hey, Rick. Dave Michaels with Bloomberg.
How are you?
Good. You didn't talk about your fixed income initiatives that are coming up on Friday. So with regards to the item that talks about fixed income pricing disclosure, can you talk about how you are going to propose to define matched pairs or riskless principal in terms of how long a firm is exposed to risk? And
Sure. Well, a couple of things. Obviously, all of these are for board consideration, and the board will make decisions whether to propose anything I'm discussing today. We're just trying to be a transparent organization and get this information out, learning from our friends at the SEC. But what we're discussing with the board, is very consistent with some of the things that Chair White raised in her speech. That and also consistent with what we've seen from a statistical analysis with regard to trades occurring on a same-day basis or often within minutes of each other, where whether it's a match trade, without suggesting that I don't like the word riskless principal because I think there is risk with respect to the vast majority of trades, and I think the value of disclosure here is not directly tied to whether it's a riskless principal trade. What we find is that with respect to that a very substantial percentage of fixed income trades in the corporate market and the MSRB, and we have found it with respect to the municipal market, occur with the dealer pulling in, and often on a trade-by-trade basis, sometimes a number of trades on the retail side and a single trade, but usually, very often, will occur within a very short period of time. What we also find is that for the significant majority of firms, the markup calculated with respect to those trades, certainly that occur within 30 minutes, and generally those trades that occur within the same day, is significantly lower than generally the markup requirements, or than the firm may provide in different situations where more risk may be taken. What we also find is that there are outliers to that conclusion, and that there are some firms who charge significantly greater markups, even with respect to times in which the coincidence with regard to time of the firm buying the fixed income bond and selling it is quite short. Pete obviously referenced some of I'll stay away from his conclusions on some of it, but referenced some of the things that result from that from an overall spread standpoint. Now, markups as a legal concept is a fairly blunt tool, and properly so, because regulators should always worry about getting too deeply into price regulation. But from a transparency standpoint, the fact that we see these trades occurring in the vast majority of cases in very short time periods, and we see significant variance with respect to the type of markups that occurs across firms, suggests to me that there could be significant value from the standpoint of allowing that information to flow to customers. Now, let me emphasize, there's lots for the board to discuss and lots for us to get comment on. The methodology, as soon as you move away from riskless principal transactions, it raises a lot of interesting questions from the standpoint of how the firm does it. even with respect to inactive bonds. And none of what I say suggests a conclusion that there's an easy and simple way. But I would suggest that this is worth looking at because for the reasons I basically said.
I think that's all we have time for.
Rick, thank you very much. We are always, it's always a pleasure to have you back on the Georgetown campus and offer very thoughtful comments. So thank you very much. And Gina, thank you for moderating this session.